Debt is a shackle for most people, but for those who understand the system, it is rocket fuel. Financial crises don't just start in markets, they start first in the human mind. Greed amplifies leverage uncontrollably, while fear evaporates liquidity overnight. Harsh reality. Most people don't go bankrupt because of crises. They get eliminated because crises catch them unprepared within the wrong structure. Wealth doesn't disappear, it simply changes hands. Today we'll discuss which side of the table you'll be on when that transfer happens. This channel is not designed for comfort, not for motivation, but for clarity.
Welcome to Foxmind HQ, where future wealth holders come for inspiration.
Debt, not an emotion, but an engineering.
Society taught you that debt is a moral burden. Debt is bad, debt is dangerous.
Yet markets are governed not by emotions, but by mathematics. Debt is leverage. If you're using this leverage to finance consumption, you are a modern-age slave. But if you're using this leverage to manage a cash flow generating structure, you are a boss candidate. For example, while housing sales declined with interest rate hikes, institutional investors like Invitation Homes expanded their rental portfolios in the falling market and secured cash flow with fixed rental agreements using debt not for consumption, but for income-generating asset control. Critical warning: debt itself is not the problem. The real issue is cash flow mismatch. Without discipline and a liquidity buffer, even the strongest leverage becomes wreckage that will bury you beneath it. The three psychological phases of crisis and transfer. Alpha Phase 1. Euphoria. As prices rise, everyone says, "This time is different." Risk becomes normalized. Analysis gives way to excitement. Phase 2.
Forced liquidation, credit tightens. People start selling not to profit, but because they have to. This is the moment when the market weeds out its weakest links. Phase 3.
Transfer. Prepared capital quietly enters without anyone noticing. Wealth is not created during a crisis, it is transferred during the crisis thanks to the right structures built long before the crisis.
Strategic advantage, the million-dollar lesson.
1. Controlled leverage. Unplanned leverage is gambling, engineered leverage is strategy. Risk must be calculated before entering the deal. Each business has its own unique analysis. 2. Liquidity equals room to maneuver. Holding cash is not laziness, it's buying an option. When others are forced to sell, the one with cash sets the rules of game. 3. Structural design. High income is not enough. The strategic investor focuses not on salary, but on capital gains and tax optimization. Small structural differences create massive wealth gaps over 10 years. Realistic positioning. 1. Liquidity buffer. Build a protective shield of at least 6 to 12 months. This protects you from panic decisions and encourages you to make purchases. 2. Systematic exposure. Abandon emotional timing. Invest systematically in productive assets, real estate business stocks. 3. Proximity to information. Learn to read balance sheets, not headlines. Information is the most valuable capital. The system doesn't reward emotion, it rewards structure. And that structure must be built long before the crisis knocks on the door. When the next downturn comes, the noise will increase. But beneath the surface, the transfer will have already begun. Wealth equals knowledge times action times time. Which variable are you working on today? In your opinion, is debt slavery or a tool? Fox Mind HQ, not for motivation, but for clarity.